Hello and welcome to this discussion brought to you by the team at My Tax Accountant. We're going to be talking about something really important today. You see, if you've ever rented out a property that used to be your home, you could be facing a surprise tax bill. And we're talking a bill of potentially over £10,000 when you sell. So we're going to break down letting relief and capital gains tax to help you understand exactly how to avoid that kind of shock. So let me ask you a direct question. Are you thinking about selling a property that was once your main home? Maybe you had to move for a new job, or your family got bigger, and you suddenly became what a lot of people call an accidental landlord. If any of that sounds familiar, you're definitely going to want to stick around. Now, take a look at this number, £11,581. That's not just a random figure. For one homeowner, that was the exact amount of their unexpected capital gains tax bill after they sold their old home. This is precisely the kind of financial shock we want to help you understand and, more importantly, plan for. It really shows you just how high the stakes can be. Okay, so here's our game plan. First, we'll get to grips with what this tax bill actually is. Then, we'll look at your two main tax shields that can protect you. We'll cover a massive rule change from 2020 that, honestly, a lot of people still don't know about. After that, we'll do the maths with a real-world example, touch on some more complex situations, and finish up with how you can get your strategy right. Right, first things first, where does this surprise tax bill even come from? Well, it's all down to something called capital gains tax, and for any property owner, it is an absolutely critical piece of the puzzle. So, capital gains tax, or CGT for short, isn't a tax on the total price you sell your house for. Nope. It's a tax on the profit you make, what the taxman calls the gain. It's basically the difference between what you bought it for and what you sold it for, minus some allowable costs. And the rate you pay depends on your income. Right now, in the 2025-26 tax year, it's 18% if you're a basic rate taxpayer, but it jumps up to a pretty significant 28% for higher rate taxpayers. Okay, facing a potential 28% tax bill sounds a bit scary, right? But the good news is that HMRC provides two really powerful tools to help bring it down. I like to think of them as your tax shields. They are private residence relief and lettings relief, and understanding how they work is absolutely key to protecting your profit. Your first and most powerful shield is private residence relief, often called PPR. Put simply, you don't pay any capital gains tax for the time the property was your main home. But here's a massive pro tip, and it's a big one. You also get relief for the last 9 months you own the property, even if you weren't living there. It's a huge automatic benefit that's designed to help people who've moved out but haven't managed to sell their old place straight away. And your second shield is lettings relief. This one is specifically for people who have rented out a property that was, at some point, their main home. It's designed to give you an extra bit of tax relief on the profit you made while it was being rented. However, and this is a big however, the rules for this have changed dramatically. So stay with me because this next point might genuinely surprise you. So this just spells out the difference perfectly. On one side, you've got PPR, which covers the time you actually lived in the place. Simple. On the other side, you have lettings relief, which is meant to help with the gain made while it was rented out. The crucial link between them is that you can only get lettings relief if the property qualified for PPR in the first place. I'm just going to hammer this point home one more time because it's so important and so often overlooked. That final 9-month exemption is a golden rule. Think of it as a bonus period of tax relief from HMRC. It doesn't matter if you were renting the property out to tenants during that time, it's still covered by your private residence relief. Okay, let's get to the part where most people go wrong. In April 2020, the government completely changed the rules for lettings relief. This is so important because any advice you might have read online or anything a friend told you from before this date is now dangerously out of date. Relying on it could lead to a very nasty surprise from the taxman. This timeline just shows how dramatic that shift was. Before April 2020, you could move out, rent out your entire property, and still claim up to £40,000 of lettings relief when you sold it. But since that date, the rules have been massively tightened. Today, in late 2025, you can only claim lettings relief if you were living in the property at the same time as your tenant. So basically, if you had a lodger. It's a huge change. And look, don't just take my word for it. As property tax expert Tony Hunter said at the time, this was a huge attack on landlords, and especially those accidental landlords we talked about earlier. People who rented out their old home not as part of some grand business plan, but just out of necessity. They are the ones most likely to be caught out by this. Theory is one thing, but seeing the numbers in black and white really brings it all to life. So let's walk through a case study together. We'll see exactly how these reliefs are calculated in practice by looking at a freelance creative worker in London who recently sold his first home up in Leeds. Okay, so let's meet Alex. He bought his house back in 2006 for £180,000 and lived there for 8 years. A fantastic job opportunity came up in London, so in 2014, he moved down south and decided to rent out his Leeds property for the next 10 years. He finally sold it in 2024 for £350,000, making a total profit or gain of £170,000. The big question is, how much of that is actually taxable? To figure this out, we're going to follow a simple 5-step process. It might look a bit daunting, but it's really not. First, we confirm the total gain. Then we'll deduct his private residence relief, check if any lettings relief applies, take off his tax-free allowance for the year, and finally, we calculate the bill. Let's get into it. Okay, let's break this down because it's really interesting how each relief chips away at that big number. Step 1 is easy, confirm the total gain. He sold for $350K and bought for $180K, so his gain is £170,000. Now for step 2, the big one, private residence relief. He owned the property for 18 years, that's 216 months. He lived there for 8 years, or 96 months. Then we add that automatic final 9 months we talked about. That gives him a total of 105 months of relief, which knocks a huge £82,639 off the gain. So far, so good? Now, here's the crucial bit, step 3, lettings relief. Remember that new rule, you only qualify if you live there with a tenant. Well, in our example, Alex rented a room to a lodger for 1 year while he was still living there, before he moved to London. And that one small fact means he still qualifies under the new rules. The relief is capped at £40,000, so we can deduct that full amount. This is a perfect example of why details records are so important. Finally, for step 4, we deduct his tax-free capital gains allowance for the 2025-26 tax year, which is £6,000. And that leaves us with a final taxable gain of £41,361. But we're not done just yet. The rate of tax Alex pays on that £41,361 depends on his income. As a successful freelancer in London, his annual income is over the higher rate threshold of £50,270. This means his property gain gets taxed at the higher rate for residential property, which is 28%. And that brings us right back to that number from the very beginning. 28% of his $41,361 taxable gain comes to a final capital gains tax bill of $11,581.08. Just think about that for a second. Without those reliefs, especially that bit of lettings relief he qualified for, his bill would have been nearly 4 times higher. It really shows you why understanding every single detail of the rules is so vital. Now, Alex's situation was fairly typical, but let's be honest, real life is often much more messy, isn't it? The moment you introduce other factors, the sums can become significantly more challenging, and the risk of getting it wrong goes up and up. For instance, if you own more than one home, you have to formally nominate one as your main residence within a strict time limit. If you don't, HMRC will decide for you, and you might not like their choice. If you're an overseas landlord, there are totally different reporting rules and deadlines. Selling part of a garden, dealing with an inherited property with a complex valuation history, or trying to offset losses from other investments. Every single one of these scenarios adds another layer of complexity that really demands specialist knowledge. So, this brings us to the final and most important part. How do you pull all of this together and make sure your own tax strategy is spot on? Let's quickly recap the most important things you need to remember. So, what's the bottom line? Here are the 3 most important things to take away. Number 1, the lettings relief rules changed completely in 2020. Forget what you thought you knew, it now almost exclusively applies if you've had a lodger. Second, your private residence relief is your number 1 tax shield. Make sure you account for every single month you live there, plus those critical final 9 months. And finally, none of this is possible without meticulous records. Dates, costs, rental agreements, you have to be able to prove your case to HMRC. Look, as you've seen, getting capital gains tax right is complex, and the penalties for getting it wrong can be pretty severe. This really isn't something you want to leave to chance. If you're in this situation, we strongly recommend seeking professional advice. The team at My Tax Accountant are specialists in property tax, and they can guide you through it all. You can reach them on 020-8570-8531. I'll repeat that, 020-8570-8531, or you can email them at info@mytaxaccountant.co.uk. Thank you so much for joining us, and don't forget to subscribe for more clear, practical tax guidance.